Okay, hello everyone. We are from Group 4. We're presenting about our analysis about financial case study about the Orient Electronic. But before that, let us introduce ourselves first. Slide. Okay, so the member of Group 5 is there Rio, Daniel, Darren, Fatir, and Sanata Putri Nindya or Indi. Next slide. So the first question of the case will answered by my friend. So,
Okay, thank you so much, Daniel. So, I will explain for the question number one, the first question. So, what does the change in inventory turnover and inventory suggest about the Orient inventory management? So, for the matrix overview first, the turnover decrease minus 26%, and for the days increase for the 20 days. So for this matrix, they are on the below industry average with the inventory moving slower than competitors. The root cause is because the overstock on the new product, the demand fell short, slow moving older inventory, and new distribution center underutilized. So the impact on financial, the cash is trapped in the slow moving inventory. So the revenue grew 25%, but the operating cash flow fell 67 from the $9 million into $3 million. So this paradox happened because the inventory build up didn't generate professional sales. So for this, the management must write write down or mark down the obsolete stock and to realign inventory with actual demand. So for the next question, I think my other member friends will continue.
okay, so for the second question, it's about increase in receivable days. So we can see that Onion's receivable is increased from 30 days in 2025 to 47 days in 2026. So this is also higher than the industrial average of 32 days. So this means the Orient is taking a large to collect the money from the each customer. So there is no one positive interpretation there. Orient extend the customer credit period from the 30 for the to the 45 days, which may have helped the company attract more corporate customer and increase its sales. But and we can see that the company revenue increased from the 100 million dollars to 125 million dollars. But however, there is also we have negative effects. There is two. The first one is um, the higher risk of overdue or uncollectible revenue because some customer already pay after 60 days. But overall, although the longer credit terms may support for the sales growth, and the increase in receivable days also create a cash flow problem and increase the correction risk. Basically, Onion selling more, but it's taking the longer to get money from the sales. Next.
Okay, so we'll begin with question 3. That is, has the increase in payable dates improved Orion's position? Discuss both the benefit and potential cost. So the benefit is that the extending payment terms to 55 days provides a valuable source of short-term interest refinancing, and by holding on to cash longer, Orion can use that cash to fund its day-to-day operations, dealing cash outflows and partially offsetting the cash drain caused by slower paying customers and rising inventory. This helps explain how the company survives its cash flow decline. But the potential cost is that the purchasing director's aggressive negotiation has already prompted one supplier to threaten to withdraw early payment discounts. Losing these discounts effectively raises the cost of purchases, eroding gross margins. If Orion continues to stretch payments, suppliers may demand stricter terms, like cash on delivery, reduce credit limits, or prioritize competitors' orders, which could lead to stockouts and lost sales. The next question is, what does the decline in total asset turnover indicate about the company's expansion? The drop in total asset turnover from 1.8 times to 1.5 times, falling below the industry average of 1.7 times, clearly signals that Orion's growth strategy has made the company less efficient at generating revenue from its asset base. Although revenue grew by 25% from 100 million to 125 million, total assets expanded at an even faster rate, meaning that Orion now requires $0.67 or 67 cents of assets to generate every dollar of revenue, compared to the previous 56 cents previously. This declining efficiency is largely attributable to management's investment into distribution centers that are operating below capacity, as well as the substantial buildup of inventory from overstocking new products and holding obsolete older models. Consequently, the expansion has created asset build and idle capacity, showing that management overinvested in infrastructure and inventory relative to current market demand. Okay, so that is all for my part. The next part will be explained by my friend.
Question is will be answered by my friend.
Okay, so for question number 5, we can see an interesting situation here. So Orange revenue is increased from the $10 million to $100 million to $125 million. So its operating profit also increased from 10 million to $11 million. However, operating cash flow decreased significantly from the 9 million into $3 million. So how can this happen? The main reason is the accounting profit is not the same as the cash receivable. So the first one, receivable days increase from the 30 to 47 days. This means that Orion has made more sales, but some money of this sales has not been collected. Then the second one, inventory days increased from the 56 to the 76 days. This means that more cash is tied up in the inventory, including newly introduction product that may not be selling as expected. As a result, Onion can report a higher revenue and profit, while at the same time expressing weaker operating cash flow. So this also supported by the increase in the short-term borrowing, which increased from the $6 million to 18 million dollars. So the key point is that Onion is making more accounting profit, but the cash is not coming in quickly enough. And next slide will present by my friend Indi.
Okay, thank you, Daniel. So question number 6 is individual understanding and teamwork. Okay, so I demonstrated my individual understanding by actively participating in the financial analysis of Orion Electronics and understanding the meaning behind the financial ratios and their impact on the company's performance. I contributed to the discussion by analyzing the information provided, sharing my interpretation with the group, and considering how working capital efficiency could affect profitability, operating cash flow, and financial risk. At the same time, I work effectively as a team member by listening to other members' opinions, discussing different interpretations, and helping the group reach a common conclusion. Each member contributed to different parts of the case, and we combined our individual findings to develop a more comprehensive analysis. Through this teamwork, I was able to strengthen my understanding while also supporting the group in completing the case study. Overall, this case study helped me understand that financial analysis is not only about performing calculations, but also about interpreting the results and communicating the effectively. Working as a team allowed us to compare perspectives and develop evidence based conclusions more effectively. This is consistent with the case study's objective of demonstrating individual understanding while working effectively as a team. Thank you so much. And next slide, please. And question 7 will be answered by my friend. Thank you.
Thank you, Ili. I would like to answer the question number 7. So the question are recommend 3 action Orion should take to improve its operating efficiency and cash position. So first, you improve inventory management by reducing slow-moving and obsolete products, especially older electronics products that are difficult to sell. Orion should also improve demand forecasting before purchasing additional inventory. And then, Orion should tighten credit and collection policies by reviewing corporate customer credit limits and following up on overdue accounts. The company should avoid allowing receivable days to remain significantly above the industry average. And lastly, they should improve the use of existing assets and control cash outflows. So Orion should increase the utilization of its 2 new distribution centers before expanding further and carefully manage supplier payments to maintain relationship while still taking advantage of available payment terms. Next slide. Okay, the last question will be answered by Rio.
Okay, for the closing question, identify 3 additional pieces of information you would request before making a final judgment. So, this is the 3 piece information that we want. So, for the first inventory valuation and aging analysis, we require a detailed inventory breakdown by product category, the percentage of inventory is beyond 90 days, and the net realizable value of slow-moving items. So without this quantification, we can access the true magnitude of obsolescence impact on the significant cash flow decline. For the second information, receivable aging and collection pattern. So we need a detailed aging schedule of receivable by period, identification of customer with payment delay, and historical collection rates under the new 50-day credit term. So this information is essential to determine whether the 47-day average represent temporary collection lags or indicate of a structural collection problem requiring provision adjustment. The third information, cash flow, composition and supplier dynamic. We require a detailed operating cash flow breakdown showing the contribution of its working capital component. Change in supply payment terms and a cost-benefit analysis comparing extended payable saving against the short-term borrowing costs. So this is critical to evaluate whether Orion working capital strategy is sustainable or merely backs deeper financial distress. So I will give back to the moderator. Thank you.
Thank you. Maybe that's all our question and our answer about the question about our case discussion today. So we say sorry if there's any mistake and we make during the presentation. And that's all from us. And see you in another time. Bye bye.